name is Elizabeth Irungu. I'm the CEO of Absa Asset Management Limited, a subsidiary of Absa Bank PLC. So 2026, there are many factors that really influenced how the year was shaping up for the investors. So in terms of inflation, we say that we closed 2025 with fairly high inflation levels globally. So you look at the developed markets, inflation levels were above 2%, and that was a worry for the markets. And for that reason, we saw most central banks hold policy rates and avoid further cuts, although we had seen central banks cut rates quite rapidly in 2025, but towards the end of the year they stopped. So in quarter one, the expectation by the market was that rate cuts would most likely continue or just they hold to be there. We saw central banks hold policy rates across, including the US, but then the geopolitical risks became quite elevated, and that may have informed some of the decisions which were made. Another thing that we noted is that global economies were growing faster. The developed markets, the local markets, we saw some recoveries in terms of performances, GDP performances, which was exciting for markets. If I just look at how that translated to our local market, inflation was coming down and we had gone below the 5% levels. It is a good thing when you see inflation well contained below the policy rate that or the rate that the central bank targets, which is between 2.5 and 7.5, and we were trading just about 4.4%. Another factor that was really top of mind in quarter one was geopolitical risks. Despite markets performing so well in January, February, in March they retreated just to incorporate the elevated risks that had now snowballed because of the US-Iran war. But the losses that we saw in the equities market especially, we saw the markets recover the following month. So in quarter two, we are seeing the markets have started recovering slowly. And I think the other thing that I wouldn't stop talking about is definitely the oil prices. Iran going to war with the US, we saw energy prices rise significantly, and that has elevated expectations of higher inflation. And we have already started seeing the inflation numbers actually reflecting the higher energy prices that are being experienced across the world. There was money made in January, February, but if you look at the quarter, you find that because of the war, crystallizing, we saw then the markets retreat, and countries like the US, we saw the S&P 500 retreat minus 4%. We saw also in Europe a minus 2.5%. We saw China also retreating minus 3%, just incorporating the latest news, especially towards the end of the quarter. So the end of the quarter seems to have dictated the returns that we saw in the global markets. However, when you look at the breadth in a month-on-month basis, there was money being made globally. Our local markets have continued to attract interest from most investors, whether it is local investors and international investors. And we saw the NSE All Share Index actually tick up to a double digit in the first 2 months of the year, having reached all the way to about 13%. When the war happened, we saw it retreat a little backward, but still we recorded a positive return. So the equity markets have remained exuberant. Investors are still comfortable with the prices that are trading in the market, and therefore it continues to be an interesting market. The other part of it is that we saw banks actually trade higher and higher. Most of that growth was driven by banking stocks, which were performing quite well. And we know that in quarter one, there's also that expectation of bank performances being released in the last month of the quarter. And most banks have actually recorded quite strong performance for 2025, which supports the prices that we have seen. In the fixed income market, which is one of the big markets, especially locally, we saw interest rates trend downwards. The central bank had cut rates, policy rates last year and continued to hold this year. But investors, because of the high liquidity and better environment, we saw investors push the yield curve further down, and therefore the fixed income markets were actually doing much better in quarter one, and we saw gains in the fixed income markets. Another thing is that there was heavy liquidity in the market, so subscriptions for government bonds, subscriptions for treasury bills were quite high, and that tells you that there were more investors who were chasing after the instruments that were being issued by the government. We also saw private sector players coming into the market and raising some debt successfully, which tells you that investors have been looking beyond just investing in the debt market by government. The biggest risk that we are facing as we crossed to quarter two, I think it's a crystallization of the war, and it is not more the war. For capital markets, the biggest risk is the inflation. For Kenya, we've already seen inflation rising from 4.6% in March, and in April, we saw inflation rise to 5.6%, telling you that the prices of energy are filtering into the rest of the economy and pushing prices a little higher. Inflation takes away the purchasing power of your money. So if you're expecting that inflation will continue going up because of the current environment we are in, then we need to position our portfolios to outperform that inflation and protect the investors against any erosion of their purchasing power, because it takes them backwards in terms of the real returns that they are getting. We've seen government take initiatives and action that will help the economy to pump better and return a higher return. I think a higher GDP number, and the GDP number that they would aspire for is the levels of 5%, but they are thrown into this conundrum with the inflation numbers going. As a portfolio manager, what do we do in this type of environment? As an investor, how do you position yourself for success? So one way is that we need to be aware that with inflation rates going up, investors will be demanding to be rewarded higher, whether it is by money market instruments, whether it is by fixed income instruments, or even in the equities market. So what we are likely to see is that short-term rates may start going up a bit, and that has already started showing signs of going up. To what extent we will rise, that is still debatable, but definitely direction-wise, we know that the direction is upward. It is best that anyone who has new money then start positioning yourself for liquid assets, because the liquid assets will be rewarding. We believe that this inflation we are seeing is transitory. So for a short period, investors will be rewarded for their short-term money. For the long-term investors, I would really encourage that we don't get dissuaded or spooked by these little disruptions that are happening, because they are real, yes, and they can disrupt and cause us to panic or to take measures that are detrimental to our long-term, wealth creation. So our journey is on wealth creation, and we are still very intentional about building resilient portfolios that are well diversified, that can carry us through these periods of uncertainties that come. So what shall we be doing? We shall be anchoring that new monies we invest more on the short-term opportunities that are coming. For the fixed income market, we'll be looking at optimizing on the yield curve and picking the positions for the yield curve which are not expected to rise significantly, but at the same time looking out for cash flows that are strong enough so that we drive cash flow returns and, of course, the capital gains returns. Equities markets are interesting. The equities market may sway sometimes, especially in the uncertainties that we find ourselves in. Those opportunities that are coming when markets go down. They're really good for you to enter and to position yourself where you had not bought. So when equity prices are coming down, we re-enter and we position ourselves for the long term, because we still continue to see NSE market giving us strong dividend yields and capital gains. So we are still quite positive around the equity markets in Kenya. And now maybe to just relate the same to the numbers that we saw in Q1, we saw the money market funds giving you about 7.3%. Remember, your money market fund is for your emergency fund, is for your transitory monies before you can deploy it. And then we saw the fixed income fund, the annualized return coming just about 20% in the first quarter. When we annualize it, that's quite a strong return when you look at if it were to repeat that performance to the end of the year. Equity fund also came in quite strongly at about 13% on capital gains, but when you add the dividend yields, which are usually about 6 to 7%, it tells you that your equity fund could actually give you up to 18% in a year that we have seen quite a bit of volatility. So my advice and my call to action is, let's build portfolios that are diversified, away from just having money market. Build your money market, have a fixed income, have an equity fund, and probably also look into offshore offerings that we also have. Thank you very much.